Hi, this week we have three interesting webinars lined up for you. At 10 a.m., there are two webinars which are happening. First one is Venture Investors Shift from Mutual Funds to PMS. Second one is Understanding Eternal, Industry Overview and Seeing the Competitive Position of Eternal. The third one is happening at 11 a.m. First crore, first salary. Budgeting, which makes your 1 crore future. The registration links for this webinar are given below. Do register and hope to see you all there.
Hi, have you ever wondered how the world's greatest investor thinks about money and wealth? Or do you want the mindset that separates long-term wealth creators from short-term speculators? If you want to follow the footsteps of one of the biggest investors in history, someone who built massive wealth not by predicting markets but by applying simple, timeless principles, then you're in the right place. Today, we'll see the 3 golden rules of investing by Warren Buffett, explained with real examples and how you can apply these through thoughtful planning and tailor-made portfolios. Rule number 1, never lose money. This sounds obvious, but most investors miss the depth of it. When Warren Buffett says never lose money, he's not saying markets should never fall. He's talking about avoiding permanent loss of capital. Market volatility is temporary. Permanent loss happens when investments are misaligned with your time horizon and risk capacity. For example, investing Rs 1 lakh in an equity instrument meant for the short term can be damaging. A 25% market correction brings the value down to 75,000. If the money is needed soon, withdrawal becomes the first response, locking in the loss permanently. While the same investment is aligned to a 10-year goal, withdrawal is not the first action. Rebalancing or staying invested allows time for recovery and compounding. Buffett protects capital by aligning investments with time horizon and risk capacity. We follow the same approach by understanding your risk profile, goals, and liquidity needs to create a personalized financial plan that helps your capital withstand market cycles and compound steadily over time. Rule number 2. Never forget rule number 1. Buffett's second rule exists only for one reason: discipline. Most investors do not lose money because market moves. They lose money because they abandon their strategy midway. An investor begins with a long-term equity plan aligned to a clear goal. Over time, another investment starts delivering higher short-term returns. The temptation is to switch, chasing recent performance. Frequent switching increases costs, taxes, and disrupts compounding. This behavior slowly erodes wealth even when the original strategy was sound. Long-term investors succeed not by predicting which investment will perform next, but by staying committed to a dedicated asset allocation and rebalancing systematically. This is where financial planning becomes critical. A structured plan defines asset allocation and lays out a clear plan of action by mapping each investment to a specific financial goal. So when narrative changes, decisions are guided by process, not by impulse. Planning before picking investments builds discipline, and discipline is what ensures capital protection over the long term. Rule number 3. Invest only in what you understand. Star investors like Buffett focus on the circle of competence, meaning they invest only in businesses they can evaluate and value. This matters because if you do not understand how an investment generates profits, it becomes difficult to stay invested when market fluctuates. Here's how this plays out. An investor who understands brand strength and consumer demand can access a retail business beyond short-term price movements. Similarly, someone who understands technology trends can evaluate a software company based on its long-term growth potential rather than short-term volatility. This same mindset applies to portfolio construction. We don't just pick funds randomly. We choose instruments that align with your understanding, risk appetite, and financial goals, ensuring every allocation has a clear purpose with your overall financial plan. Why these rules matter today? Buffett's investing philosophy isn't old school. It is timeless. Across decades, cycles, and crises, investors who focused on capital protection, discipline, and understanding have outperformed those chasing quick returns. This is not about predicting the markets. This is about designing a process that survives and ultimately thrives through uncertainty. Warren Buffett's success was never about predicting markets or finding shortcuts. It was about protecting capital, staying disciplined and invested with clarity over long periods of time. These three rules work not because they are complex, but because they are consistently followed. When investing is backed by planning, discipline replaces emotion and volatility becomes manageable rather than frightening. The real advantage in investing is not information, it is structure. When every investment has a purpose, every goal has a plan, and every decision follows a process. Wealth creation becomes a journey of confidence rather than uncertainty. That is the mindset of a serious investor, and that is how long term wealth is built. Come talk to us. Let's build your strategy so you can invest with confidence, sleep well through market cycles, and feel like a big league investor every step of the way. Click on the link in the description to call us now.